Business ownership is one of the best ways to generate wealth and create financial freedom for you and your family. Welcome to the Aquila Wealth Podcast. Listen in as we tackle the challenges of entrepreneurship and share how to remove financial procrastination and find freedom from financial stress. Your host is Eric Maldonado, founder of Aquila Wealth Advisors, LLC in San Luis Obispo, California. Here's Eric.
All right, we're looking at top solopreneur finance strategies, according to myself. What's a solopreneur? Someone who owns a business, could be husband and wife, spouses that own the business, could have kids as well, a part of the business. But the main thing is there isn't other employees. So it's just you. Maybe you have some 1099 support staff or even subcontract workers, but you don't have any true blue W-2 employees besides yourself or your spouse, or even paying your kids, which I'll speak to in a moment here. So I'll give a few top solopreneur finance strategies. So if you're a solopreneur, an entrepreneur who is the owner operator of your business, and you want some ideas or some strategies for personal finance or business finance, the first one is a solo 401k. So what's better than starting off with something that has it in the name, solo? Solo 401k means that you can set up a 401k, which is a retirement plan for yourself, for your business. And the main thing is there isn't other employees, and you can sock away a lot of money pre-tax, tax-free for the future. In other words, Roth, a Roth 401k, as well as profit sharing, which would be a deduction for your business. And you can do up to $73,500 if you're over age 50. Is the max number there. Otherwise, it's $66,000 a year that you could put in total into the entire solo 401k. And that could make a huge difference in the future of your retirement planning. There's the Roth and pre-tax employee contribution component. So you're an employee of your business. If you are an S corp, in this example, then you can, and even if you're a sole prop, you can pay yourself, you can fund up to $22,500 and another $7,500 a year if you're over age 50. You have to make at least that much money through your business to be able to fund that. And you can do, in addition to that, profit sharing, which would be you as the employer contributing into the 401k. And depending on your entity type, determines the percentage of your income or profits that you can fund to the profit sharing account and get that as a deduction against your business. So it's a twofold strategy. There's tax strategy here as well as retirement planning and investing for the future. So that's a separate topic. Once you get the money into the 401k, which you can set the solo 401k up at various institutions, and then you'll have your separate accounts, pre-tax, Roth, profit sharing, even after tax, which would be another strategy to fund after tax monies that are able to be rolled over to a Roth IRA one day in the future. But that's getting a little bit too much in the weeds for now. Just know that you have these separate accounts, Roth, pre-tax, and profit sharing, that you would then invest for the future, depending on your investment style. And you can invest in all sorts of things, mutual funds, ETFs, stocks, bonds, money market, cash, and hopefully have it grow for the future to keep up with inflation and create a lifetime income stream into retirement and throughout the rest of your life is the idea. And 20% is more if you're a sole proprietor. It would be the profit sharing is 20% of your net profits, which there's a calculation there. So it'd be good to work with, of course, a CPA as well as a financial advisor. 25% would be if you're an S corp or a corporate incorporated, an LLC taxes an S corp, for example, then you would be able to put 25% of your W-2 wages. So if you made $100,000 W-2 salary through your business, then you could put $25,000 into your pre-tax and take that as a deduction against your business. In addition to another $22,500 you could put into the Roth or the pre-tax employee contribution, plus another $7,500 if you're over age 50. So that's the solopreneur tactic. And you You can also do that for your spouse. So times two, basically those numbers for your spouse, if they're working and a part of your business. Okay, next, solopreneur finance strategy is the business entity selection, which I've kind of already spoken to that concept of business entity selection a little bit. But oftentimes, the default mode is just a sole proprietorship, which you're just raising your hand to start a business. You get an employee identification number, an EIN from the IRS, and you're off to the races. You then start setting up your bank account, your business bank account. You have your business license for your city or whatever location you're at, and you keep things separate from your personal, and all your business stuff stays in your business bank accounts. And that's kind of the default sole prop method. And there's not you can, as far as tax planning, there you can deduct on your Schedule C, which flows right through to your 1040, page 1 there, all of the business related expenses in your business. But outside of that, there's no real way to strategize for like the self-employment tax, which is about 15.3% of your profits for the year. So then the next level would be to do an S corp and be incorporated. There's also a C corp, which is a little bit more esoteric, or you don't see it as much. A C corp is more like publicly traded companies because you can have more than 100 shareholders. An S corp tends to be most common for solopreneurs and small business owners. Once they get past the sole prop stage and they're actually making real money, whether that's $50,000 to $100,000 plus per year, there's a range. And of course, you'd want to be working with a CPA and a financial advisor to do some of this business entity selection stuff. But I'm giving you the high level strategies so you can be equipped with them as a solopreneur and see what the big benefits are. The majority of the tax code in America is set up for business owners to utilize it in terms of the number of pages in the tax return. A large portion of them are regarding rules on how to, deduct expenses and have cash flow through your business. So an S corp is a good tool. One of the main reasons is, and I'll draw here on my whiteboard if you're watching on YouTube, is to be able to split up your wages and potentially save on some S corp tax, self-employment tax, which would be 15.3%. So for an S corp, you have your W-2 income, which is like your salary that you would decide, with your tax preparer, how much is or your advisor, how much is a reasonable amount to pay yourself. And that's what you would use a payroll company like Gusto, for example, that would send you a monthly or bi-monthly paycheck, just like you would for any job. But then you would also be able to take owner draws or owner distributions. And the owner distributions, which could be like a quarterly dividend, in effect, are not taxed for self-employment income, which would be federal Medicare and self-employment and Social Security, which is about 15.3%. So you can save yourself a good chunk of money if, let's say, your business has $100,000 of net income minus expenses, and you pay yourself. And said if you're a sole prop, then you're going to pay 15.3% on that entire 100,000 on top of federal and state income. So that's 15K that you'd be paying and change towards taxes. But if you're a W-2, and let's say, with the help of a tax preparer, which would help you, a tax advisor and a financial advisor, which would help you determine what the right amount of W-2 is, because it's based on reasonable salary and comparables to the work you're doing. But you would be able to determine how much you pay yourself W-2. So let's just say you pay yourself $50,000 for the year, a salary. That $50,000, which is half of the $100,000, is, in this example, is taxed at self-employment tax and federal and state. But then the other $50,000 you could take as an owner draw or a distribution. And let's just say you take them as quarterly draws, so 50,000 divided by 4. And that 50,000 is not taxed self-employment tax. So you save yourself half the self-employment tax, which is about $7,500 in this example, that you would not have to pay tax on. It just goes straight to your pocket, your bottom line as a business owner. So that's the benefit of an S corp. An S corp tends to be oftentimes not the default mode, but sometimes you start with an S corp mainly because there's a little bit more expenses. With a sole prop, there isn't any entity expenses. In California, an S corp or an LLC, an S corp, you pay $800 a year as a state tax, and then you also have to take into account some administrative or organizational expenses. You'll have to file a separate tax return, which often involves some expenses with a tax preparer. An LLC is actually not a tax saving vehicle per se by itself, because an LLC can be taxed as either a sole prop, which is also known as like a disregarded entity. So by default, an LLC is taxed as a sole prop. The LLC, which stands for limited liability company, just allows you conceptually better protection from your personal stuff to be separated into your business stuff. So it's meant to limit the liability if you properly keep all of your cash flow and income and expenses separate from your personal. So you wouldn't be buying business stuff with your personal expense credit card, and you wouldn't be buying personal stuff with your business credit card. So you would really need to separate things. But the benefit of an LLC also allows you to elect to be taxed as an S corp at a later time. So let's say you're starting out as a sole proprietor, as a solopreneur, and you're just trying to get things going, and you're not really making a whole lot of income in the first year or two, but eventually you start bringing in $100,000 or more, for example. Now you say, okay, I want to start paying myself a reasonable salary and take owner draws, like a quarterly dividend, just like publicly traded companies pay dividends, and start doing a little bit more. And maybe an S corp also involves having to do payroll for yourself. So it adds some complexity, which is why you would want to do it at the right time and not necessarily do it at the beginning when maybe you don't have the cash flow that you expect to have in later years. So that's some strategy on business entity selection. Hopefully that's helpful. Next, I have about 3 more on these solopreneur finance strategies. This is number 3, if you're counting, would be paying your kids. So if you have kids, if you have a family, and you want to utilize another tax strategy, so this would fall under the tax strategy bucket of solopreneur finance strategies. You can actually pay your kids, and someone would say, well, why would I do that? Well, first of all, you have to have them actually be doing some real work, whether it's social media, modeling, website, photography, filing papers, cleaning the office. And as they get older, they can do more stuff, of course. And again, as with any of these, you'll want to work with a CPA or an advisor to make sure to do this properly, because there's compliance that has to be abided by per the IRS to do this correctly. But if you're a sole proprietor, it's really easy because you don't have to necessarily do a whole lot of things to pay your kids. You just pay them, and of course you'll want to follow the directives of a CPA in terms of whether or not you need to file a tax return for them or do any sort of other administrative stuff. At the very least, you want to have like some formalities in terms of what their role is, how many hours they're working, what your hourly paying for them is. If you're an S corp, and so the whole benefit of paying your kids, before I go into that, is being able to not have to pay taxes on the portion that you pay them, because if they're under age 18 in 2023, you can pay a child, a minor, one of your kids, up to $13,850 a year and not pay any tax on it. Now it has to actually go to them through either an account that's has their name on it, a bank account that's separate for them, or what's called a UTMA account, which is like a trust account for a minor, which you would own as the parent, but they would be the beneficiary of it, or even a Roth IRA, which is kind of a super strategy, if you will, for the future, to save for their future with some serious planning that you're doing as the parent, because you're basically creating a retirement vehicle for them when they're kids, which is kind of crazy to think about. So you could set up a separate Roth IRA for them and they'd have tax-free assets for the future. However, if you're an S Corp or an LLC taxed as an S Corp, you can't quite pay your kid directly and still not have to pay the self-employment tax. You'd have to pay the 15.3% self-employment tax on them and have them on payroll and file that way. The way to avoid the self-employment tax is by utilizing something called a family management company, or FMC. And again, there's a lot of nuance here, and you want to properly set this up with a tax preparer and a financial advisor. But the idea is that you would have a separate family management company that, say, your spouse is in charge of, and your company, your S Corp, would essentially be billed a fee from the family management company, which manages your kids as employees. And that fee would then be paid out from the family management company to your kids' accounts, whether it's UTMAs, a minor trust, or Roth IRAs, or just a separate bank account that they own and that their name is on. Because ultimately you want to have a paper trail and actually have the money go to your kids. So there's some nuance there. You'd want to utilize a separate payroll company to properly pay them through the family management company, have an EIN, an employee identification number for this family management company, and do the paperwork or the agreements that shows, okay, I'm employing my kids and this is the work they're doing. And so it's formalized and above board. It has to be real work that's being created. But if you're, let's just say, all in paying 35% taxes, including federal, state, and self-employment, $13,850 would save you about $4,000 to $5,000 a year of taxes by paying your kids. And then also there's, to me, the bigger benefit of including your kids into your business and giving them an entrepreneurial mindset and teaching them work ethic and all those types of things. Okay, next, number 4, also tax related, would be something called an accountable plan. So again, if you're an S Corp and you're essentially an employee of your own business, even though you're a solopreneur, you wear 2 hats. One is the employer, one is the employee as the S Corp. You can create an accountable plan, which again, not to be a broken record, you'd want to set up with your tax advisor and your financial advisor to make sure it's done properly. But it's essentially a ledger or a spreadsheet that tracks expenses that are justifiably business related that you can then reimburse yourself as an employee and thus get a business tax deduction. So you can reimburse yourself for things like a home office, travel, mileage for your car, cell phone, internet. All those types of things would be reimbursable based on whatever percentage of those items are used for the business. So let's say your cell phone is used 50-50 business, personal, then you can write off half your bill or half your expense for your iPhone from your business. And then lastly would be a health savings account. So this is getting more into the health insurance topic, which a lot of people are fearful of what their healthcare costs would be if they ever make the leap from employment to being a business owner or a solopreneur. A health savings account is one way to kind of lessen the blow or give a little bit more solace when it comes to dealing with healthcare and being a business owner. So you would have to select what's called a high deductible health plan, which has, like it sounds, higher deductibles. But the benefit is then you could have this separate health savings account that you can save into and get a deduction on your taxes by saving that into that account. So if you're an individual in 2023, you can put up to $3,850 per year into a health savings account. If you're a family, you could put $7,750. And if you're over age 50, you can put an additional $1,000 as a catch-up. So that's, a good chunk of change that when you when you deposit, let's say $7,000 or fund throughout the year $7,000 into an HSA, a health savings account, those monies are then not taxed. So it's a tax deduction, a tax expense that you get to deduct from your tax return and not pay tax on. The other big deal or big opportunity with the health savings account, which takes a little bit of a perspective shift from using it as like a current reimbursement plan for your. So let me explain that. The health savings account, the money that you put into there, you can then reimburse yourself and pull the money out tax-free for any healthcare related expenses. So like doctor's visits, anything related to healthcare, even certain health related like products you can buy at the drugstore, you can reimburse yourself for, and kind of take that as a deduction. So if you were charged copays or some sort of a hospital fee, then you can essentially just take it from your health savings account and get a deduction for that health insurance cost. The perspective shift comes when you want to use this as like another wealth building tool, almost look at it as like a separate retirement account, because you're actually allowed to invest depending on the health savings account that you set it up at, the company that you set it up at. You can actually invest those funds into, say, mutual funds or exchange traded funds, and use those at a later point. So it becomes like this wealth building tool that you can then reimburse yourself on expenses at a later time. So there's actually no time limit on when you reimburse yourself for those health related expenses. So let's say you have a big expense or just expenses throughout the years, you can basically save those receipts, and decades later, after the money has been invested and grown, you can pull that out tax free as a later expense. So they kind of call it a triple tax benefit, because you get a deduction on the way in, you get to pull it out tax free, and you get to invest it tax deferred. So while the money's being invested, you don't pay tax on it. Another caveat is once you reach age 65, you're allowed to essentially treat it as an IRA, an individual retirement account. And even if you don't have health expenses to reimburse yourself, you can still pull the money out without any penalties. It just becomes like an IRA. You get taxed for the withdrawals, like regular income tax rates, federal and state, but you don't get penalized. Because if you take money out of the health savings account early and it's not for health related expenses, then there's a penalty as well as a tax on it. So that's my 5 solopreneur finance strategies. Just to recap: the solo 401k with the Roth and the pre-tax, and then you can also do profit sharing and get a deduction for your business. Business entity selection: you can set up an LLC to begin with and be a sole prop, but eventually you can switch to an S corp when you have enough income flowing through, and you can separate your salary from your owner draws and get a self-employment tax break, essentially. Paying your kids all above board, of course, within the parameters of the laws, and fund a Roth IRA for their future, make them a millionaire before they're even there, basically based on compounding if you invest it in the right companies or in the right funds. And if you're an S corp, you can utilize something called a family management company, which of course you don't want to do all this with a tax preparer, and pay yourself up to, it doesn't have to be this much, it could be much less obviously, but up to, if it's justifiable based on the hours and the work they're doing, $13,850 per child. That's per child. So if you have 4 kids, it'd be times 4. And you wouldn't pay tax on that. Number 4 would be an accountable plan, which is essentially a reimbursement mechanism for any expenses that you have personally, but that are business related. So like a home office, travel, mileage. And then lastly would be the health savings account, which you can also turn into an investment vehicle. You can sign up for my newsletter at aquilawealth.com /newsletter, where I talk about a lot of this stuff. And until next time, take care.
Thank you for listening to today's episode of the Aquila Wealth Podcast. Want more tips on how to be financially stress-free? Sign up for our monthly newsletter and join over 400 subscribers in receiving insights for maximizing your business and personal finances. Go to aquilawealth.com/newsletter or click on the link in the show notes. And tune in next week for a new episode.
Please see the show notes for important disclosures regarding Aquila Wealth Advisors, LLC, and this episode. All communication in this podcast is for information purposes only and should not be considered tax, legal, or investment advice. All information or ideas provided should be discussed with an advisor, accountant, or legal counsel before implementation.